Johor Plantations Group Berhad, one of the well-established plantation companies in Malaysia. The company has a long history in the palm oil industry and is closely linked to Johor Corporation, which is a major state-owned investment organization in Johor. In 2024, Johor Plantations was officially listed on Bursa Malaysia, marking an important milestone in its growth. Today, the company is involved in the cultivation of oil palm, the production of crude palm oil, and several downstream businesses. With its strong focus on sustainability, innovations, and operational excellence, Johor Plantations continue to strengthen its position in the Malaysian plantation industry. Far East Holding Berhad, also known as Far East. The company was established in 1973 and is headquartered in Kuantan, Pahang. It is listed on Bursa Malaysia under the plantation sector and mainly operates in the oil palm industry. Far East Holding focus on the cultivation of oil palm and the production of fresh fruit bunches, crude palm oil, and palm kernel products. With over 50 years of experience, the company has built a strong reputation in the Malaysian plantation industry through its commitment to sustainable growth and efficient plantation management. Both companies operate in the same plantations industry, but are their performance same? Today we will analyze Johor Plantations and Far East Holdings. Which company has a stronger financial performance?
I will present the financial ratio analysis of Far East Holdings Berhad based on 5 main categories, which are liquidity ratios, leverage ratio, profitability ratios, activity ratios, and stock market ratios. First, for liquidity ratios. For the current ratio, Far East Holdings Berhad increased from 2.67 times in 2024 to 3.23 times in 2025. This shows that the company's ability to cover its short-term liabilities improved. Since the ratio is above 1, it indicates that the company has sufficient current assets to meet its short-term obligations. For the quick ratio, it also increased from 2.57 times to 2.87 times. This means the company had stronger liquid assets, such as cash and receivables, to pay its immediate liabilities without depending on inventory. Next, for leverage ratios. The debt ratio decreased from 15.36% in 2024 to 14.12% in 2025. This indicates that the company reduced its reliance on debt financing. A lower debt ratio is generally positive because it shows lower financial risk and a more stable capital structure. For times interest earned, the ratio increased significantly from 37.92 times to 53 times. This shows that the company has a strong ability to pay its interest expenses because its earnings are much higher compared to its interest obligations. Therefore, the company faces very low financial risk from borrowing. Moving on to profitability ratios, the gross profit margin slightly decreased from 23.43% to 23.28%. Although there was a small decline, the difference is not significant. This may be due to increases in production costs, labor costs, or other operating expenses. However, the company still maintained a stable profit margin. The operating profit margin decreased from 21.7% to 19.97%. This suggests that operating expenses increased during the year. Possible reasons include higher maintenance costs, administrative expenses, or transportation costs. Despite the decrease, the company still maintained a healthy operating profit level. For activity or efficiency ratios, the accounts receivable turnover increased from 9.45 times to 12.09 times. This shows that the company collected its receivables faster in 2025. A higher turnover ratio indicates better cash flow management and more efficient collection procedures. The total asset turnover increased from 0.48 times to 0.56 times. This means the company was more efficient in using its asset to generate sales compared to the previous year. Lastly, for stock market ratios, the earnings per share increased from 32.02 cent to 40.31 cent. This indicates that the company generated higher earnings for each ordinary share. The increase reflects improved profitability and may provide better value to shareholders. The price-earnings ratio increased from 1.22 times to 2.38 times. This shows that investors were willing to pay more for the company's earnings compared to the previous year. This may indicate improved investors' confidence, although the ratio is considered relatively low. In this case, Far East Holdings Berhad showed overall improvement in its financial performance in 2025. The company has stronger liquidity, lower financial risk, better efficiency, and higher earnings. Although some profitability margins slightly declined, the company remained financially stable.
Now I will continue with the financial ratio analysis of Johor Plantation Group, Berhad or JPG for the years 2034 and 2035. Firstly, let's look at the current ratio. The current ratio of Johor Plantation Group Berhad increased from 2.47 times in 2034 to 366 times in 2035. This indicates a significant improvement in the company ability to meet its short-term liabilities using its current asset. Generally, a current ratio above 1 is considered satisfactory, while a ratio above 2 reflects a strong liquidity position. The increase may be due to higher cash balance, growth in current assets, or a reduction in current liabilities. Next is the quick ratio. The quick ratio increased from 2.32 times in 2024 to 3.39 times in 2035. This suggests that the company had more liquid assets available to settle short-term obligation without relying on inventory sales. Since the ratio is significantly above 1, JPG maintained a very strong liquidity position. The improvement may be attributed to higher cash reserve and more efficient management of receivables. This indicates that the company will have a little difficulty meeting its immediate financial commitments. Let's move on the leverage ratios, which measure the company financial risk and debt position. The debt ratio decreased from 47.50% in 2024 to 39.47% in 2025. This means that a smaller proportion of the company asset was financed through debt. A lower debt ratio generally indicates lower financial risk and greater financial flexibility. The decrease may have a result from debt repayments, growth in total asset, or increased shareholders' equity. Although the company still carries a higher debt ratio than some pension companies, this improvement suggests a stronger capital structure in 2025. The time interest earned ratio, or TIR, decreased from 9.05 times in 2024 to 5.64 times in 2025. This indicates that the company's ability to cover interest expense from operating earnings weakened during the year. Although the ratio remains above the minimum acceptable level, the company is still able to meet interest obligation comfortably. The decline may be due to higher interest expenses, increased borrowing costs, or lower growth in earnings before interest and tax relative to finance costs. Now let's examine the profitability ratio to evaluate how effectively the company generates profit. The gross profit margin increased from 36.25% in 2024 to 36.92% in 2035. This indicates that the company generates slightly more gross profit from each ringgit of sales. The improvement may be due better selling price for crude palm oil, improved plantation productivity, or more efficient cost management. The increase demonstrates that the company maintains strong control over its production costs while generating higher revenue. The operating margin improved from 27.06% in 2024 to 29.20% in 2035. This showed that the company became more efficient in converting revenue into operating profit. The increase suggests that operating expenses were well managed and that revenue growth outpaced operating cost increase. A margin of more than 29% is considered strong and reflects effective operational performance activity. Move on, let's discuss the activity or efficiency ratios, which measure how effectively the company utilizes its resources. The account receivable turnover ratio increased from 28.07 times in 2024 to 36.88 times in 2025. This indicates that the company collected receivables more quickly and efficiently during the year. A higher turnover ratio is generally favorable because it improves cash flow and reduces the risk of uncollectible accounts. The improvement may be due to stricter credit policies and more effective collection procedure. The total asset turnover ratio increased slightly from 0.31 times in 2024 to 0.32 times in 2025. This indicates a modest improvement in the company's ability to generate sales from its asset. Although the increase is relatively small, it suggests that JPG utilized its asset more efficiently in 2035. The low ratio is common in plantation companies because plantation assets such as land and biological assets are large and require significant long-term investment. Finally, let's look at the stock market ratio, which provide information about the company values from investor perspective. The earning per share or EPS increased from 11 cent in 2024 to 14 cent in 2025. This indicates that the company generate higher earning attributable to each ordinary share. The increase reflects improved profitability and is generally viewed positively by investors. A rising EPS suggests that shareholder value has increased during the year. The price-earning ratio decreased slightly from 0.12 times in 2024 to 0.11 times in 2025. This means investors were paying slightly less for each ringgit for earning compared to the previous year. The decrease may be due to change in market sentiment or a slower increase in share price relative to earning growth. Despite the slightly decline, the very low price-earning ratio may indicate that the stock is undervalued by the market or that investors remain cautious about future industry performance. In conclusion, the ratio analysis shows that Johor Plantation Group Berhad recorded improvement in liquidity, profitability, and operation efficiency and earning performance in 2035. The company also reduced its dependence on debt, which strengthened its financial position. Although the time interest and ratio declined, JPG remains capable of meeting its interest obligation. Overall, the company demonstrated positive financial performance and stronger financial stability in 2025 compared to 2034. With that, I will now hand over the presentation to our next presenter. Thank you.
Hi, I am Nurwahida binti Al-Wahid. Now I will present our decision and conclusion based on the financial ratio analysis of Johor Plantation Berhad and Far East Holding Berhad. Based on our analysis, both companies demonstrated satisfactory financial performance in 2025. They maintain strong liquidity position, low financial risk, and a positive profitability. However, after comparing the financial ratios, we recommend Johor Plantation Group as the preferred stock investment. Firstly, JPG performed better in terms of liquidity. The company recorded a current ratio of 3.66 times and a quick ratio of 3.39 times, both of which were higher than Far East Holdings. This indicates that JPG has a stronger ability to meet its short-term obligation and maintain financial stability. Strong liquidity is important because it reduces the risk of cash flow problems and allows the company to continue its operation smoothly. Secondly, JPG also demonstrated stronger profitability. The company achieved a gross profit margin of 36.92% and an operating profit margin of 29.20%, which was significantly higher than Far East Holdings. This result shows that JPG is more efficient in controlling costs and generating profit from its business operation. In addition, its earnings per share increased from 11 cents to 14 cents, reflecting improved returns to shareholders. Another important factor is the profitability trend. While Far East Holdings recorded a higher earnings per share of 40.31 cents, JPG achieved higher gross profit and operating profit margins. This suggests that JPG is more effective in generating profit from its sales and daily operations. Higher profit margins provide greater flexibility to withstand fluctuations in palm oil prices and rising operating costs in the future. Although Far East Holdings performed better in debt management and interest coverage, JPG still showed stronger overall performance. The company improved its debt ratio from 47.5% to 39.47%, indicating that it is gradually reducing its reliance on debt financing. JPG also demonstrated efficient receivable collection and continued improvement in its operating performance. Furthermore, in the plantation industry, companies require substantial investment in land, biological assets, and processing facilities. Therefore, operational efficiency and profitability are often more important indicators of long-term success. Based on these factors, JPG appears to be in a stronger position to sustain its competitive advantage and generate future returns. In conclusion, financial ratio analysis help investors identify companies with strong fundamentals and make informed investment decisions. Therefore, based on the overall analysis, JPG is the preferred investment choice. The company offers stronger liquidity, higher profitability, improving financial performance, and better growth potential compared to Far East Holdings. Therefore, JPG appears more capable of creating long-term value for its shareholders.